This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Anas's picture that says, looking for the downloads. Eric, let's cover crude oil, starting with those EIA inventory data.
Breaking news just in. The Biden administration did not recklessly pilfer any more oil out of the SPR this week, which would have been the 16th consecutive week if not for the pause. Kidding aside, it's going to be really interesting to see whether this is a pause or if they're actually done looting this strategic national asset of the United States. Crude oil drawing down 708,000 barrels. Cushing, Oklahoma drawing down a massive 2.9 million barrels. I have to apologize. I've been away from the market because we've been shooting my energy documentary this week. So I don't know what the news is, but normally when you see that big of a drawdown in Cushing, it usually means there's been some kind of disturbance or anomaly in the physical distribution network. There was some oil that was meant to be pipelined into Cushing this week that didn't get there for some reason, is my best guess. Gasoline drawing down 1.1 million barrels. Distillates drawing down a de minimis 14,000 barrels. U.S. production holding unchanged at 12.3 million barrels. We're right at the make or break point for crude oil. The continuation 200-day moving average is at 77.21. That's the ceiling above the market. A sustained breakout above that level would be massively bullish on a technical level. But from Anas's comments in the feature interview, it might be too early to expect that. And right here at the 200-day moving average is where we peaked in April after the surprise announcement from Saudi Arabia and OPEC. Of course, that was a higher dollar price back in April, but it's the same moving average. So on a technical level, a failure here could spell one final retest of the lows before the market finally turns around in Q4 or even Q1 if you go by Anas's fundamental outlook timing. But a sustained breakout above 77.21 on WTI would suggest that the market is forward-looking enough to already be discounting the fundamental factors that Anas described as affecting the market later in the year. So, Patrick, I'd love to get your take on how your technical interpretation jibes with mine and what specific levels you're watching on crude to tell you when the final bottom is really in and when it's time to start buying all the dips aggressively.
You know, Eric, sometimes when we're talking oil and, we can talk some of the short-term fibs and some of the technical signals that are occurring, but I really wanted to step back and really zoom out and see a bigger and very important trend that has happened over the last year. You can see crude oil peaked out in June of last year, and we've been in more or less a 1-year bear market in oil. And really, it was in July of 2022 where we had a breakdown of the 200-day moving average. And some famous traders like Paul Tudor Jones swears by the 200-day moving average as a depictor of trend. And one can see that oil has basically remained for an entire year below its 200-day moving average, including now 2 direct tests into that 200-day moving average. And that 200-day moving average today is trading at $77, a level we were just at last week. And so it'll be really interesting to see whether we finally see a bullish breakout of this 200-day moving average and whether this bear market decline that can be defined by that shifts. Have we broken above it? No. But and that's what I think makes it a really interesting thing for many of our listeners to watch, because I think that oil progressing towards the those April highs, $80 plus, and then we see a pattern of higher highs and higher lows and some sort of signs of accumulation as the old dips are being bought. If we see those characteristics, that could create a second half of the year rally that could have us, let's say, testing 2022 highs from the fourth quarter, somewhere near $90. But let's watch that 200-day moving average and see how it plays out. Nonetheless, Eric, what are your thoughts here on equities?
I think a retest of all-time highs above 4,800 on the S&P is now far more than 50% likely. The reason is that with this much upside momentum, and particularly with this week's acceleration in the rate of price appreciation after last week's breakout above the 61.8 fib retracement level, my take is that if you want to express a bearish fundamental view, the technicals are telling you that you probably better wait for a double top, and you might even want to wait for a move to new all-time highs above that top. Wait for the blow-off top that Darius Dale predicted before you actually try to short this market, because it looks to me like you're going to get run over if you try to do it here. Thinking longer term, it's time for all of us intermediate-term bears to at least recheck our assumptions and figure out how this market already got to almost new all-time highs, so that we already have our plans made when that actually happens, and I think it's coming soon. A whole lot of very, very smart MacroVoices guests in recent months have echoed the same message, that the final bottom isn't in yet for this bear market. And if they all got that primary market call about the bear market bottom not being in yet wrong, and they got it wrong together, well, that probably means that we all got some other stuff wrong together too. So we should all start reevaluating our assumptions. Personally, I'm trading gold and crude oil markets actively and quite happy to pass on equities until my own technical and fundamental views start to align with one another.
Yeah, I want to talk about the charts on the S&P here in just a moment, but let's get Nick in the conversation. Nick, what levels are you watching? I mean, we have option expiration this week, obviously. Sometimes gamma pins in there, but it really hasn't stopped this market from trending. You're now starting to watch the August OPEX, right?
That's correct, yeah. So right now, Patrick, the spot price on SPX is 45.65. We have a call wall above at 4,600, which is also a key area of resistance. We have a put wall below at 4,300. This is for this coming Friday, July 21st OPEX. Now, the implied move for the August 18th OPEX is 120 points up or down. So the upper expected move is 46.85, and the lower expected move is 44.45. Key areas of support right now are at 4,500, 4,400, then 4,350, then 4,300.
I couldn't agree more with you, Nick, and just in terms of some short-term overhead resistance. But
now, right now,
what I have on
I do think we're overextended a bit.
Is simply a chart that depicts where those 2021 and 2022 highs came in, right around this 4,600, and then the other high much closer to 4,800. Now that we've beaten all fib zones, these previous highs obviously are short-term magnets that traders are often targeting, but we've already had such an enormous run. The only thing to observe is that even if you're skeptical about the sustainability of this run, to me, what I see is that there's no evidence that the bulls have in any way dropped the ball on this drive. Like the momentum continues, there's no reversal candles, no topping formations, no key breaks of major support lines. Patterns like buying quick dips are happening over and over again. And so really we can be skeptical about the short-term resistance levels, but there's simply no reversal sign yet. That doesn't mean that we shouldn't be paying attention to it. With such an overextended market on the short term, I think could very easily trigger a sell cycle, just no sign of it yet. Moving on though to the NASDAQ here, Nick, what levels are you watching on the Qs?
Spot price right now on QQQ is 383. We have a call wall above at 385 and a put wall below at 370. The implied move for the August 18th OPEX is plus minus 16 points. So the upper expected move is 399, just below that key area of resistance at 400. And the lower expected move is 367. The next key area of resistance is at 409, which is at the all-time highs for the NASDAQ. And key support is at 370. So right now, as I mentioned in previous weeks, I do think that tech is very overextended, and I'm favoring the small caps over big tech. And that's proven to be a pretty good bet so far, because we've seen the Russell outperform tech pretty handily over the past week or so. And I expect that to keep up over the next few months as well. And moving on to the US dollar index on page 6, guys, what are your thoughts here?
Well, it seems that make or break is in vogue this week because, as I said earlier, that's where we are in the crude oil market, and that's where we stand with the dollar. We saw that breakdown below 100 on the Dixie last week, which could portend an outright drop much lower if that level doesn't hold. But then, just as we should expect in technical analysis, we got a nice rally back to retest that same 100 level on Wednesday, but this time as resistance rather than support. A rejection here, and particularly a daily close below 99, would signal a dollar breakdown. A sustained move back above 100 could mark the beginning of a significant bullish correction, negating the fake breakdown below 100 and flashing a new bullish signal. But for right now, the name of the game is to watch closely what happens next. A break above 100 or below 99 will be the tell for the next leg, and that's a much narrower range, so it should resolve quickly.
Eric, since I was using that 200-day moving average on oil, I thought it would be appropriate to also bring it in here on the chart of the U.S. dollar. And what's interesting is that we were holding quite an important support along that 101 level, which also was very close to a key Fibonacci zone. That was an area that I speculated could act as a key support for an intermediate period. That clearly has now broken, and you can see that we're now on a sustained basis below that 200-day moving average, making lower highs and lower lows. This is a very weak market that is continuing to break down. This is going to be really interesting to see whether or not we start heading back to 2021 levels. I mean, if we see any type of a sustained breakdown here that continues, that while it certainly would be weak for the dollar, it certainly would be actually a bullish tailwind on a lot of other risk assets, particularly commodities. And so what will be interesting in my mind to see whether this U.S. dollar trend continues, because it certainly could be the tailwind that things like gold, oil, copper, and so many more other commodities may need to just actually have some sort of a bull impulse.
Now on page 7, we have the gold futures chart. What are your thoughts here?
I think gold is still trading as a reciprocal play on the dollar to a large extent. The market may be starting to discount the fundamental driver of this new BRICS reserve currency, creating additional demand, but frankly, I doubt it. I think the gold bounce is probably just all about the dollar breakdown, and as we already discussed, the dollar is at a make or break point, so when the dollar's next leg becomes clear, gold's going to follow in the opposite direction.
Eric, staying with that same theme for the whole chart deck, I left that 200-day moving average. Unlike other commodities, gold actually has always remained a stone throw away from its all-time high. We put in that high back in 2020, retested in 2022, and retested again earlier this year. This entire pause in the gold advance has really just been a consolidation wedge. Notice it stays above its 200-day moving average, and overall was not a very deep pullback relative to the pullbacks we saw both in 2021 and 2022. What'll be really interesting to see is if gold can get above 2,000 and start retesting those all-time highs again. If it's staying above its moving averages and working up there, it certainly could be the conditions that allow gold to make a major breakout. Will that we see that? That's certainly something that remains on my mind. So then moving on to page 8, what I really wanted to do different in today's chart deck is actually talk about today's market conditions because they're very unique. Today, Nick, we have an environment where we have multi-year lows on volatility premium on options. The short vol community is back. You have a lot of covered call writing, overwriting going on. You have obviously historically low realized volatility levels that have been dragging volatility down, which generally the way that our listeners can kind of relate to that is that it generally makes options cheaper. And we have not seen volatility this low in many, many years. And so on page 9, we have that VIX chart. The VIX, our volatility index, measures 30-day volatility, which is always a shorter time frame. This is why on the next page I have a longer dated one. But I mean, you have to basically now go back to 2017 to 2019 to see levels this low on volatility. And it's really interesting because overall, we still have a monetary policy where the Fed is basically trying to fight asset prices, raising interest rates, trying to generally slow the economy. Typically, one would think that this is a period that would have heightened volatility, but yet here we are with very, very low volatility premiums. I find it so interesting.
right now we have a period of low volatility that's being driven by complacency by investors predominantly. And typically what you see is these explosive moves to the upside in volatility, typically driven by some kind of catalyst event. Now, we don't know what that event is right now, but looking at the historicals over the past few months for as they pertain to monthly OPEX. So just for reference, the last 5 monthly OPEXs, post-OPEX, the following week's returns are as follows. So for the February OPEX, the following week, we had a minus 3.52% drawdown in SPX. The March OPEX, we had a pop of 2.21% following the monthly OPEX. The April OPEX, we had a decline of 2.08% following the monthly OPEX. The May OPEX, we had a decline of 2.26% following that OPEX. And the June OPEX, we had a decline of 2.5% the following week post OPEX. So this coming Friday, which is tomorrow, is very important because if we do close near the highs again, I think we see a short-term pullback, and that's where you might have that window of weakness. It might be short-lived perhaps, but these are the key areas where you can take a pretty high probability trade based on statistics. And so looking at the volatility index right now and seeing how cheap insurance is right now because there's less demand for it, primarily because a lot of market participants are choosing to go with long calls versus long equity, which is more capital efficient rather. We could see a nice pullback of 2 to 3% in a pretty fast time frame. Also factor in that next week we have FOMC as well on Wednesday. So there's a confluence of factors here at work, between the historicals on post-monthly OPEX, FOMC, and then also, historically speaking, the first 3 weeks of July are very, very bullish. We're exiting that window the first 3 weeks of July. So we're pushing into that August lull where a lot of the algos take over and everyone's on vacation.
Well, it's interesting you say that. The other factor beyond the FOMC, we have 3 central banks. We have the ECB and the Bank of Japan, which is a lot of questions about their yield curve control, but it's also the heart of the earnings season. And really, this entire rally has been an expansion of multiples. We haven't seen corporate earnings in any way uptick. And this is why I think this corporate earnings cycle is going to be so important, because if companies start to disappoint or fail to rise in a way to confirm these very bullish price action in the market, that could be the conditions where we have this period of stability lead to a new period of instability. And it'll be interesting to see whether the next few weeks become the start of that. On page 10, though, I have the 6-month volatility index. So just to put that in context for those that are not familiar with it, it's simply saying that when you're going 6 months out and you're pricing volatility premium, what is that? So it's a longer dated VIX, basically. And what you can again see is that whether we did the 1 year one last week on the chart deck, but here's a 6-month one. Again, we're not far from that incredibly low vol condition in the 2017 to 2020 period that led to some very violent volatility that came in the last 3 years. The key, though, that I want to talk about here, Nick, is that today's market conditions are incredibly unique. And I'm going to do a special webinar for free for any of our listeners that want to attend in terms of the option strategies that work ideally in these types of market conditions. So let's kind of go through what these market conditions are. We have multi-year lows on volatility premium, making options generally the cheapest on a relative basis that they are, especially if one was to believe volatility will return in the second half of the year. The second thing is we have incredibly high interest rates. And the third is we have trending equity markets. I mean, we had in the last 9 months, essentially the S&P 500 rise 30% or like close to 1,100 points higher, and is relentlessly rising at a period where it's all multiple expansion and not supported by earnings expansions or at least earnings growth. And the interest rates are now at an interesting crossroad. And one of the reasons, or I want to bring up the interest rates here, Nick, is that if you look on page 11, I have the 3-month SOFR futures. This is the September 2023 contract, which is showing close to a 5.5% yield for where interest rates are. But what's interesting is when I show on that top right-hand corner where the SOFR futures are for the different quarterly expirations going for the rest of this year and next year, they are basically anticipating the high of interest rates here in the coming months, and that interest rates will, even a year from now, be 1% or more lower than where they are today. And so we are at a moment where, at least based upon the way SOFR futures are trading, we are seeing peak short-term interest rate, because long-term bonds like 10-year and 30 years, they may still fluctuate based on other variables, but at least in terms of short-term money, we're seeing a peak. The interesting part about that is the influence of interest rates on option pricing, particularly the fact that when Rho is working for or against you in the option Greeks, especially for longer dated options or that have to factor in more interest rates. When interest rates are rising, like we have seen over the last year and a half, it basically contracts put options and makes call options more expensive to factor in the arbitrage. And so there's a whole array of interesting ways of playing options in the index markets to complement these types of interest rate forecasts. So if you believe we are seeing peak interest rates and you believe that interest rates are likely to decline in going into next year, at least on this 1 and 2 year duration bonds, there are certain option strategies that benefit from it. And so we have this condition here, Nick, where we have very cheap volatility premiums, an interest rate environment that is favorable to certain types of options, and we have a stock market that is extended and very mature. Now, there is no evidence that a top is going to come in right here, right now, but if you believe that inevitably, after whether it's a month or 2 months from now, and whether it's 200 S&P points higher, if you believe at some point there is a risk that there is going to be a 20% drop in the S&P 500, and there's a good chance that inevitably it happens, and you're looking for a low-cost, low-risk way to hedge and protect your portfolio against these kind of conditions, that's exactly what we're going to be covering on this webinar. So on July 25th at 1 p.m., I'm going to be hosting a special webinar on the option strategies perfect for today's market environment. And I'm inviting all the MacroVoice listeners that want to attend completely for free. You can register at bigpicturetrading.com/money, or there's also a link included in the chart deck.
Folks, if you want to learn about the option strategies ideal for trading and hedging today's market conditions, you can find the link in the Research Roundup email or on the last page of the chart deck. You can alternatively go to www.bigpicturetrading.com/money.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.